Okay, let's talk about Eurjpy. Now, this wasn't a setup that I sent out on the Discord. Okay, start over. Okay, let's talk about Eurjpy. Now, this wasn't a setup that I sent out in sharp markups during New York session on the Discord, but this was something that we went over on a live session, right? At the end of our live sessions, what I do is I go through a certain amount of pairs, I mark them up, give an analysis, and I say, let's see what happens. This is one of the trades that we talked about in one of our live sessions. So Eurjpy, it starts off with this demand zone here. So the reason why this zone is valid is, per usual, when we see a huge impulse like that, or any impulse for that matter, we look for the origin of that move, right? Because this is where the demand or supply zone would be with these type of moves. In order for them to buy the market up like this, they have to hedge their positions. So they have to sell the market before they enter in and put the money in to make the market go up. So the way these zones work is this is when the banks hedge their positions. This is when they close or mitigate their positions. Because when they go in, they sell and then they buy afterwards, but they keep the sell positions open. So while they're making their money going up, they're in drawdown from the move that they did to balance the market as it goes up, which is the sell before they entered into that trade. Anyways, structure broke. That's what validated this as a proper demand zone. So all I have to do is wait for the market to go to that zone, and then I'll drop down to the 5 and look for my confirmations. So you guys understand that looking at something like this right here, never enter the market early. The rule is you must wait for the zone to be reached. Do not take any trade or try to chase any trade that comes close to the zone and runs off, because they do that on purpose to get people to buy in, to make them think that the market is moving early when it's not, so that they can come back down, liquidate those guys who couldn't control their impulses, and then bring the market up, right? Which we're going to drop down to the 5-minute time frame. We'll see. So there's 3 parts to a trade. Okay, those 3 parts are: 1, trade analysis; 2, trade execution; okay, and 3, trade management. Okay, now those are the 3 elements to being able to trade consistently. So you have to know these 3 elements of a trade. So we've completed the analysis. We see what happened. Here's our analysis. We have our demand zone. This demand zone is valid because of the reasons I mentioned already. Now, step number 2, trade execution. How are we getting into this trade? Okay, so we already avoided the early execution. Okay, and this is where people make their mistakes. If something happens in the market, the areas that you can make mistakes in are going to be in one of these 3 areas. Either you made a mistake in your analysis, you made a mistake in your execution, or you made a mistake in your trade management. So now an execution error, for example, would be you entering the market early. A second execution error would be you jumping in the market right now without confirmation because you just think and believe it's going to go up. That'd be an error. What you have to do is you have to wait for your confirmation, which down here I'm looking at the AO. This is a momentum confirmation. As soon as I see a blue bar, that's what my entry would be. Okay, just following the rules. I get in there, stop loss there, put my stop loss half a pip below the low of that last candle, and then I wait. I hold this trade until structure is broken. I don't look to get out, even if I get an opposite momentum confirmation, unless structure has broken first. I have to wait and see what this trade actually wants to do. Okay? So we see what happened. We actually got stopped out here, and that's okay. That can happen when you are trading these type of zones, right? But this is the same reason why you should never over leverage on any given trade, because you never know what the market wants to do. How do you know that there wasn't more liquidity below in the deeper half of this zone that the market wanted to go to? How do you know that the money wasn't sitting here that's going to drive the money back up? You don't know that. Okay, so in this case, this is called a normal loss. And in trading, there's something called normal losses, which is the losses that you have to take in order for your strategy to work. I had to take this loss in order for my strategy to work. And what we can see is if you go back into that zone, all you do is wait for the confirmation again, and boom, there's our blue bar, and we get back into the trade. There's not too much to think about. The only reason you would have an issue doing what I just did is if perhaps you over leveraged on this trade and you had too great of an expectation for the market to make its move right then and there. But you can't have those expectations. You cannot decide when or where the market is going to make its move. You just have to follow your rules and nothing else. So now that I'm in a trade, the only rule is this, right? My exit strategy, as we know, is we wait for the momentum to reverse, and when the momentum reverses, we exit. Okay? On a simple basis, that's it. I hold this trade until I get a opposite direction confirmation in terms of momentum. However, that does not apply until the market breaks structure. The market has to first decide what it wants to do. It's either going to be a winner or a loser, and I don't decide that. The market decides that. And I don't look to exit unless the trade's a loser or if it becomes a winner. Okay? So I'm going to hold this trade regardless of what the outcome is. It doesn't matter. But I'm not looking to get out until I see a break of structure. Okay? And here's a perfect example of that. I see this red bar momentum, which would be a confirmation to exit this trade. However, I'm not going to exit a trade if it hasn't even had the time to decide what it actually wants to do. I don't know if this market wants to go up. I don't know if it wants to go down. It hasn't decided anything yet. So I'm going to continue to hold this trade because it hasn't went anywhere. And there's our confirmation that this trade is actually going to be a winner. So when I say a trade is a winner, what that means is there is no reason why you should be leaving this trade with the loss. A winner means at this point, there is no reason why you should be leaving this trade with the loss. Absolutely none. Okay. And even at this point, I don't put my stop loss to entry, right? Stop loss to entry is something that I don't do unless, I mean, I just haven't done, I just don't do it at all, actually. I don't move my stop loss to entry because people that move their stop loss to entry, that's giving the market a, the ability to liquidate and collect more money to take the market back up. So when trading, moving your stop loss, have you ever seen something where you're in a trade and then it goes into profit, right? And then it comes back, hits your stop loss at entry, and then continues to go back in profit? The reason why the market did that is because there was so much money sitting, and when I say money, I mean stop losses. There was so much money sitting at entry that the guys that are in control of the market, they just had to come back down and collect it before driving the market back up. And what we can see here is that, wait a minute, I spoke way too soon. In this case, the market ended its move here. Okay. So once you're up 1 to 2.5 or 1 to 3, you should look for your exit confirmation to get out of this trade. Okay. This is a decent enough amount of profit. Even though it's only 3 points, those 3 points add up when you see multiple opportunities each session, each day, right? It doesn't have to be a 1 to 7, 1 to 10 for you to be super profitable, right? So this was the first piece. Now that that move is complete, let's pay attention to what happened next. So when you're looking at certain trades, you'll see that when you use things like top-down analysis, the way that works is when price reaches a zone, you wait for confirmation on the next time frame down to find the next zone. For example, if I wanted to, if I have an H1 zone here, right? Let's say I have an H1 zone, but I only trade markets on the 15-minute time frame. I have to wait till the market comes here on the H1. Right now, once it's there, I drop down to the M15. And on the M15, I need to see confirmation that the market wants to go back down. And then this is the zone that I would actually trade. Okay, so that's an example of top-down analysis. The H1 turns into the M15, and then from the M15, if we get once I'm in that zone, I drop down to the 5-minute time frame, and if I get confirmation on the 5-minute time frame, right, which is some sort of break of structure, now I have a 5-minute supply zone, which is what's going to be the case here, right? So from the 15-minute time frame, I drop down to the 5 and I look to see if there's a 5-minute break of structure, which is we have right here. This was a break structure on a 5-minute time frame. And what I can do with that is I can look at the deepest move down before that move up. This entire impulse here, this is a strong move. That move started here with this white candle. Okay, this white candle right there is what started that move. And this is what I would wait for my next potential opportunity to get into the market. So the only rules that change when you have a M5 demand zone is instead of waiting for a 5-minute confirmation, because this is a smaller time frame zone, I'm gonna wait for an M3 confirmation. Right now I'm on the 3-minute because I want an earlier confirmation because this zone is on a much smaller scale. So as soon as I get that blue bar for the momentum, that's when I enter into my trade. Okay, and per usual, I hold this trade until, well, first I need to see that structure breaks before I think about using any sort of exit strategy. Let's freeze right there. Right? So like I was saying before, this is a perfect example of why you should not put your stop loss at entry, at least until after you see that structure has been broken. Right? And by the way, wicks don't count. And even this wick doesn't count. My stop loss still would not have been at entry unless I get a strong close above structure. Right? Because the people that did it early, the people that moved their stop loss to entry, they got liquidated. And let's watch the next candle. A huge impulse up, right? Now, what this tells you when you see anything like this is that there was a lot of liquidity that was collected and swept here. And for the market to make such a move, right? And we're on the 5-minute time frame. For the market to make a 37 pip move in a matter of minutes, less than 10 minutes, that shows me that there is a huge amount of liquidity here, and they had more than enough of what they needed to drive this market up, and that this market is probably going to start to uptrend. Right? So that right there actually gives me a reason to hold this trade a bit longer than usual. Okay? Now, getting into trade management, right? Sometimes you can use your discretion to decide if you want to hold the trade longer or not. I don't recommend it. It can get complex. It's a very advanced thing to do. It can get quite emotional. I would recommend just exiting as soon as you see momentum reverse. In this case, right here, I got a red bar. I would highly consider exiting right here. I'm already up 1-3. Why risk trying to hold this trade to see if it goes any higher? I don't need to do that, especially if I hit my target for the day. But if I was to do that, here's how I would use my discretion. I see that there is a huge impulse here, right? That means that this created an area of demand, which is this entire white candle. This is that push down before the push up that broke this structure. The market's probably going to want to come back down to that zone, and I have to be okay if the market wants to run through the zone and go down to stop loss, because that can absolutely happen, right? So even deciding to hold a trade as opposed to closing it after getting your confirmation is a risk of not making any money at all, or actually losing money, because I would have to commit to holding this trade until the zone is broken. But this is where I would wait and see what the market wants to do. And right there, I got that reaction. So now that I got that reaction out of the market, that tells me that the market's going to do one of two things. It's either going to break structure, and I have to commit. I can't exit halfway. Once I decided to hold this trade, I have to commit to either losing here, or if the market decided once to reverse there, then okay, now I can move my stop loss right underneath this low, because if it goes any deeper into the zone, it's probably not going to be the winner. It's probably going to go back down to stop loss. So I would at least leave with something, but I have to be okay with leaving with that 1-to-1 risk to reward. Anyways, I hold this and I do nothing until the market either breaks structure above or comes back down to hit that stop profit. And this is total disregard of our exit strategy. Again, we don't use our exit strategy until the market decides what it wants to do, and you don't know what it decides until it breaks structure either upwards or downwards. Okay? It's only when this market is in the air, which is now that it broke structure, this market is now in the air, that we look to get out using our exit confirmation, which just now on this red candle, or this red bar here, shows that the momentum has died and we are out of this trade. Okay, pretty long breakdown on this one because we did show off some trade management skills, but this was EURJPY.